Welcome back to Incompetent Capital, where we do what Wall Street refuses to, hold analysts accountable. Today, we're setting our sights on Five Below, a company with massive potential that seems to have been completely misunderstood by not one, but four different analysts. You'd think with this many experts chiming in, someone would have a clue. Yet here we are, watching these so-called professionals get it embarrassingly wrong in ways that make you question whether they've ever actually researched the stock at all. What went so catastrophically wrong? How did four analysts, armed with the same data we all have access to, come to conclusions so wildly off the mark? Was it pure oversight, lack of due diligence, or just blind optimism? Whatever it was, their calls missed the bigger picture in a way that should make any investor wary. Today, we'll peel back the layers and show you how these experts managed to botch the opportunity. But more importantly, we're going to teach you how to sidestep the same traps they fell into. Because if there's one thing we know for sure, it's this: relying on flawed analysis could be the difference between growing your portfolio or watching it crumble. And speaking of avoiding costly mistakes, if you want to stay ahead of the game, in a world where bad analysis and missed opportunities are all too common, you need to leverage the tools that are shaping the future. AI is revolutionizing the way we create, analyze, and grow. And YouTube is no exception. The few who learn to harness its power will be miles ahead of those who don't. That's why if you've been looking to build a successful YouTube channel, you have to check out Matt Parr's Tube Magic course. It's designed to teach you how to use AI to craft compelling content, optimize your reach, and turn your channel into a revenue-generating machine. Click the link in the description and unlock the future of content creation today. But before we dive into how these analysts botched their calls, let's take a moment to consider the financial cracks they completely overlooked. There were major red flags, misjudged market trends, completely off-base growth projections, and some serious missteps that should have had any analyst raising an eyebrow. Yet somehow, these so-called experts missed it all. Stay tuned until the end, where we'll do a deep dive into the financial landscape they failed to navigate. Order in the incompetence court. Our first defendant, Michael Lasser of UBS, didn't just miss the mark. He managed to send the incompetence compass spinning in circles. His take on Five Below was so off course, we have to wonder if he was analyzing a different company altogether. Buckle your seatbelts, my friends, because this one's about to go off the rails. Michael began his coverage of Five back in November of 2014. He jumped in headfirst with a series of buy calls that more or less matched the stock price. Then right before the bull run, and more or less until the stock peaked, he decided to go neutral on the stock. And after the first peak, he segued into a buy call, which he held into the first trench, on the way up to the grand peak and into the trenches today. To add insult to injury, while he essentially played chase and matched the stock price through most of the run, he decided to begin overbidding by about 23%. What the hell were you thinking, Michael? Had you simply swapped that final run with a sell, you would be getting a special award for about a decade's worth of competence, something we rarely see on Wall Street. Usually we frown on neutrals, because we think that that is often done as a euphemistic sell in which the analyst is attempting to manage relationships with the companies that they are supposed to be scrutinizing. But Michael's initial buy thesis in the period of 2014 to 2017, that was then swapped with a neutral as the stock climbed, can actually demonstrate how neutral calls should be done. You call buy when it is a value, and you call hold as it climbs until it is overvalued, and then you call sell. Great job on that part, Michael, but unfortunately, you didn't tell them to sell, and instead, you segued into a buy and began to overbid. Guilty as charged with gross incompetence. We'll give him probation and community service, because he did some good work in the beginning. Clean yourself up, Michael. We don't want to see you back in here. Our next defendant, Jeremy Hamblin of Hallum, stands charged with heinous first-degree incompetence, and unlike his friend Michael, he doesn't even have a single moment of competence in his entire streak. Jeremy began his coverage of Five in late 2017 and didn't hesitate to cheer the stock on. We usually like when analysts take such a definitive position in the beginning, but unfortunately, Jeremy segued into a neutral buy as the stock began to hit its first peak. Okay, not too horrible, until he decided to give a ridiculously overpriced buy of 168 when the stock was in the 130s and about to tank to the 50s. And then he incompetently held on to this call with price-chased overbid targets into the first trench and all the way to the next peak into the next trench and again into the next peak where he finally segued into a hold call, which was actually a weak buy, hold, and then the stiff hold was in the trench, and thus much, too late. These guys need to stop calling neutral when they know they should be saying sell. It's obvious that these guys are scared to piss off their owners. I mean their bosses, who pressure them unofficially because calling sell risks soiling the relationships that the firms hold with some of their biggest iBanking clients, who also happen to be the very companies that they are supposed to be reporting accurate analysis on. Conflict of interest much? You betcha. Guilty as charged and sentenced to a life of unpaid number crunching at your nearest investment bank. Matthew Boss of JP Morgan began his coverage of FIVE in June 2018 with an overweight call, which quickly ballooned into an overpriced overweight call. And shortly after that, Matthew became weary and gave a neutral overweight before the stock began to tank. I don't know what to make of this. Normally, I would call that he is giving a euphemistic sell and engaging in relationship management for his firm, but I will demonstrate in a minute that this guy is clearly not guilty of that behavior here. In the first major trench, Matthew lowballed his neutral overweight and then began making buy calls. This was weird because it was way too late on the price target and didn't even match the stock price. It's really hard to figure out what this guy was doing. Either he's smoking some good stuff, or he's onto something and actually doing his work, something we're not used to on Wall Street, so it makes the situation hard to read. After this low ball, he began to chase and cheer with matching overweight calls until the first peak, at which point he upped the ante and continued to cheer with consistent overbid calls, which began with a bid of 266 when the stock sat around 205, an approximate 29% overbid, which actually hit around 51% at one point when he lowered the bid to 252 in a failed attempt to chase, while the stock sat at 166. He held on to this overbid overweight stance more or less while chasing the stock price down into the next trench, at which point he continued to cheer with overweight calls but tempered the level of his price targets, only to give another weirdly placed overbid overweight call of 237 when the stock was trading around 199 about a year before its descent into the abyss. But this was where things got interesting. As the stock took a nosedive, Matthew segued into a neutral call, horribly timed, and way too many lost way too much money off of this call. But this is the interesting thing. Normally, I would say neutral is a relationship management tool, i.e. analysts don't want to say sell because they often act as unofficial relationship managers between their firms and their firm's biggest iBanking clients, who are also the companies that they are supposed to be scrutinizing with their assessments. But Matthew turned around and is currently segueing into an actual sell call on this one. So incompetent? Yes. Guilty of malfeasance? No. And ballsy to make a sell call? It seems that this guy is actually attempting to do the right thing, but is just not very competent at it, at least as this stock is concerned. We would issue a lighter sentence for the incompetence, given the good intentions shown in the behavior. What do you guys think? Leave your sentence and reason in the comment. You guys are the jury on this one. Our final defendant today, John Heinbockel of Guggenheim, is being charged with salary swindling. John has been covering FIVE since 2017 and has done nothing but play chase and cheer with this stock price. Every call was a buy, and almost every price target matched the stock's chart, except for a few. 7 years on the stock, coverage through all the peaks and trenches shown, and not a single thing to say except buy, guilty as charged of salary swindling, and ordered to pay every penny of his salary back to Guggenheim. Disclaimer: incompetent capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on. As we wrap up our analysis of these analysts' astounding missteps, it's essential to take a step back and consider the broader context surrounding FIVE below. Understanding the company's fundamentals, market position, and recent performance can shed light on just how drastically these experts have missed the mark. With its unique value proposition and target demographic, Five Below operates in a competitive retail environment that has undergone significant shifts in recent years. By examining the underlying factors that influence its growth trajectory, we can better understand the pitfalls these analysts stumbled into and how you can avoid similar traps in your investment journey. So, let's dive into the background of Five Below and explore what makes this company a fascinating case study in the world of stock analysis. Five Below is a specialty retailer that offers a wide variety of products, primarily targeting a youthful demographic, including teens and tweens. Founded in 2002 and headquartered in Philadelphia, Pennsylvania, the company focuses on providing fun and trendy items at prices typically set at $5 or below, with some products priced slightly higher. Its product assortment includes toys, games, tech accessories, fashion items, and seasonal goods, appealing to budget-conscious shoppers looking for value. The brand's engaging in-store experience, characterized by bright colors and a playful atmosphere, has helped it carve out a niche in the competitive retail landscape. With a rapid expansion strategy, Five Below has grown its footprint significantly across the United States, aiming to reach new customers while maintaining a strong presence in existing markets. Despite its strong brand appeal and growth strategy, Five Below faced several critical challenges that ultimately led to its stock's decline. Initially, the company experienced rapid expansion, opening numerous new locations each year. However, this aggressive growth outpaced its ability to effectively manage operational efficiencies and supply chain logistics. As a result, the company struggled with inventory management, leading to excess stock and markdowns that hurt profit margins. Additionally, Five Below's focus on low-priced goods made it vulnerable to fluctuations in consumer spending, especially during economic downturns. Rising inflation and shifting consumer preferences further compounded these issues as customers became more selective with their discretionary spending. The company's product offerings, while initially trendy, began to lack the innovation needed to keep pace with changing market trends, leading to stale inventory and decreased customer interest. Moreover, the company's financial reporting and forecasting proved to be overly optimistic, resulting in significant misses on revenue and earnings expectations. Analysts and investors lost confidence in Five Below's leadership and strategic direction, leading to downgrades and negative sentiment in the market. All of these factors combined created a perfect storm that contributed to the significant downturn in Five Below's stock price, highlighting the disconnect between the company's growth aspirations and its operational realities. As we reflect on the lessons learned from Five Below's recent struggles, two critical insights stand out for investors navigating the unpredictable world of stock markets. First, when it comes to company guidance, it's crucial to remember that it's just that, guidance. No one can predict the future with certainty, and overly optimistic projections can lead to disappointment. Instead of placing undue weight on a company's forward-looking statements, investors should focus on past performance as a more reliable indicator of future success. Following Warren Buffett's strategy, look for companies with a solid track record over the past 10 years minimum. Such a history can offer a clearer picture of a company's resilience and stability, reducing the reliance on speculative forecasts that may not materialize. Second, investors must remain vigilant about inventory levels. A bloated inventory can signal potential issues within a company, indicating overproduction or a lack of demand for products. Key financial metrics to watch include the inventory turnover ratio, which measures how often a company sells and replaces its inventory within a given period. A low turnover ratio may suggest that a company is struggling to sell its products, leading to excess stock and potential markdowns that can erode profitability. Additionally, the days inventory outstanding (DIO) metric can provide insight into how long inventory sits before being sold. High DIO values may indicate inefficiencies that could impact a company's financial health. By keeping a close eye on these indicators, investors can better gauge a company's operational efficiency and mitigate the risks associated with poor inventory management. Feel free to check out this video for a deep dive on financial statement analysis. This video provides a great foundation for anyone new to this practice.